There are two versions of Canada, and most people only ever live in one of them. In 2026, there are two completely different tax systems running side by side. One is built for the employees, the T4 workers, the people whose income shows up on a single slip every spring, the people who quietly pay for the roads, the hospitals, and the schools. The other is built for the owners. And here is the part nobody tells you on graduation day. It is not a secret society. There is no hidden handshake, no back room. It is simply a different mathematical route to the very same destination. Tonight, we are going to map that route, turn by turn. Picture your income as water. For the average worker across the GTA, that water flows in a single, direct stream. The moment it leaves the tap, the moment you are paid, it slams into a giant government filter. The CRA sits at the very front of that stream, and in a province like Ontario, the top of that filter can pull out more than 53% of everything passing through. 53.5%. More than half of every additional dollar, gone before it ever reaches your reservoir. The wealthy do not stand in that stream. They build a bypass road. They route their wealth through a series of holding boxes, corporations, and at the entrance to those boxes, the government collects only a small toll. On the first 500,000 Canadian dollars of active business income, a qualifying corporation pays a combined rate of only about 12%, 9% to the federal government, and a few points on top to the province, 12% versus 53%. The rest of the water stays in the reservoir. And a reservoir that is never drained is a reservoir that grows. This is the first thing to understand about wealth in Canada. The wealthy rarely earn money the way you do. You earn personally. Every dollar you make is taxed at your personal rate, at the very top of that 53% filter, before you are allowed to do anything with it. The owner refuses this. The owner's company earns the money, pays the small corporate toll of roughly 12%, and then, this is the quiet magic, leaves the rest inside the box. Consider what that actually means. If you keep $1 personally, you might have 47 cents left to invest. If a corporation keeps that same dollar, it has around 88 cents left to invest. That gap is not small. Money left inside the corporate box compounds on a far larger base. It can grow close to 3 times faster over the years, purely because the tax was a toll and not a flood. The owner has not dodged the tax. The owner has deferred it. And deferral, stretched across decades, is a superpower. So how does an owner actually live? How do they buy groceries? Here is where salary and dividends split apart. A salary is employee income. It runs through the full personal filter, and on top of that it triggers CPP, and in many cases EI, extra costs stacked on both the person and the company. The owner takes a different road. They pay themselves a small, modest salary, just enough to cover the basics and keep their RSP room ticking over. And then, for everything above that, they pay themselves in dividends. Dividends flow out of profit the corporation has already been taxed on, so the system uses something called the Dividend Tax Credit to make sure that income is not taxed twice, once in the company and again in the person's hands. That credit is the balancing mechanism. It is what keeps the structure fair, and it is what lets an owner draw a comfortable income while legally sidestepping the CPP and EI costs a salary would have triggered. Small salary, topped up with dividends, double taxation canceled by the credit. That is the owner's paycheck. Now let me correct a myth, because this is where people take the wrong turn. A TFSA is not a hiding place. A holdco is not a hiding place. Nothing here is concealed from the CRA. Every piece of it is filed, declared, and fully visible. These are not hiding places. They are shields. Picture the taxman throwing tax arrows across a field. The employee stands out in the open, and every single arrow finds its mark. The wealthy person is standing in that same field, in plain sight, but behind a pane of glass they constructed themselves, entirely within the rules. The arrows still fly. They simply do not land. A TFSA lets investments grow and come out the other side completely untouched. A holding company lets profits sit and compound behind that same glass. The wealth is never invisible. It is merely protected. Here is the move that feels almost unfair the first time you see it. When you want something, you reach for your income to buy it. Income that has already been dragged through the 53% filter. You are spending post-tax dollars. The wealthy try never to do this. Instead of selling an asset and triggering tax, they borrow against it. They walk into the bank, put up their portfolio as collateral, and take out a loan. And a loan is not income. The CRA cannot tax a loan, because it is money you must pay back. So the owner funds their life without ever tripping the tax filter. Then comes the second layer, the logic behind what Canadians call the Smith maneuver. When borrowed money is genuinely put to work earning income, invested rather than simply spent, the interest on that loan can become tax deductible. So the truly structured owner does not only borrow tax-free, where the rules allow it, they turn the very cost of borrowing into a deduction that shrinks the bill further still. The asset stays put, the wealth keeps compounding, and the lifestyle gets funded straight off the top. There is a specific feeling that arrives when this finally clicks. It usually lands on some quiet morning, perhaps at the start of tax season, when you are staring at the numbers and you realize something has shifted underneath you. For years, you were a minority partner in your own success. The government took the majority share of every dollar you produced and handed you back the remainder. And then, one morning, the math flips. Suddenly you are the majority owner of your own results, and the government has become the minority partner. Nothing about you changed. Only the structure did. Now, the smartest way an owner turns growth into cash, capital gains. Here is the 2026 reality, and I want to be precise because there was an enormous amount of noise about this. For a stretch, the government proposed raising the capital gains inclusion rate and threatened a two-tier system above $250,000. That proposal was canceled. It never became law, so for 2026, the rule is clean, and it is generous. Only 50% of a capital gain is taxable. 50%. The other half is simply yours, free and clear. Sit with what that does. Ordinary income is taxed at up to 53.5%, but a capital gain, because only half of it counts, is effectively taxed at roughly half that, about 26.8% at the very top in Ontario. Same dollar of wealth, half the tax. That is the real sweet spot, and it is not tucked inside a threshold or a loophole. It is nothing more than the difference between being paid as a worker and growing wealth as an owner. The structured person arranges their affairs so their money arrives as gains rather than salary, and lets that 50% rule do the quiet work. And the final structure is the one that thinks in generations, the family trust. A trust is a box that holds assets for the people you choose. In 2026, the old game of freely sprinkling income across family members has been tightened hard. The CRA's split income rules now shut most of that down, unless those family members are genuinely involved in the business. But the trust carries the heaviest weight at death. Canada has no formal death tax, yet it has something that behaves like one. When you die, the CRA treats you as though you sold everything you own on that final day, and the gains are taxed all at once. A properly built trust, paired with what is called an estate freeze, lets an owner lock in today's value, pass the future growth cleanly to the next generation, and soften that last deemed sale. It is how wealth crosses from one lifetime into the next, without the entire reservoir draining at the border. So let us be clear about what this actually is. Paying less tax in Canada is not cheating. There is no fraud here, no hidden account, no lie, no scheme. Every box, every shield, every toll road is written directly into the law, the same law sitting available to the person standing in the open field, taking arrow after arrow. The only real difference is knowledge and the willingness to build. Because in the end, true freedom is not a bigger salary. A bigger salary just pours more water into the same filter. True freedom is the moment you stop being an employee of the system and become the architect of your own mathematical reality. Two versions of Canada. You were just handed the blueprint to the second one. If you learned something, make sure to like this video and hit subscribe. See you in the next one.